The bond market, the stock market, and the real estate market all have been clamoring for a rate cut from the Fed and for a new bout of QE. The verbiage has been everywhere. They're clamoring for it because the last time there were rate cuts and over $3 trillion of QE, it triggered a wonderful decade for the markets when nearly all asset prices surged together, even as the economy grew at historically lousy rates. After surging for 10 years far faster and far more than the economy, nearly all assets are now overpriced, including stocks and housing. Now, prices have gotten snagged in a lot of volatility, and for the markets, the next big shove is needed, and it would have to come from the Fed. But how do you get the Fed to cut rates and start QE all over again? Wall Street hopes that a recession will force the Fed to do that, and so they're also clamoring for a recession. The idea is that during a run-of-the-mill recession, stocks would surge because of the rate cuts and because of a new bout of QE and the ensuing flood of cheap money. Surely we're going to get a recession sooner or later, but what if it's later rather than sooner? What if that recession doesn't show up? And therefore the Fed won't cut rates and will not even discuss restarting QE? What would happen to stocks and to the broader markets once they figure out that these dreams of a mild run-of-the-mill recession with big rate cuts and trillions of dollars of QE aren't turning into reality? What would that big letdown do? Ladies and gentlemen, I'm Wolf Richter of WOLFSTREET.com, and you're listening to the Wolf Street Report. It's Sunday, March 24th, 2019. The bond market has been fighting the rate hikes from get-go. As the Fed started to raise rates seriously in 2017, short-term yields rose, but long-term yields didn't. The yield curve started to flatten in 2017 and was nearly flat for most of 2018. In late 2018, it started sagging in the middle with a 3-year yield lower than both the 1-year yield and the 5-year yield. So already the yield curve was inverted in the middle. This sag in the middle then started to expand outward this year, with the sag deepening and widening. In the past week, the 10-year yield dropped 20 basis points to just 2.44% on Friday. It's now lower than the 1-month yield. The 1-month yield is 2.49%. In other words, short-term money offers higher yields than long-term money. This is a classic inversion of the yield curve. All this happened because the Fed raised its policy rates, and those rates were transmitted to the short-term paper, and the short-term yields rose in line with the Fed's rate hikes, but the long-term yields have a mind of their own. All the yields between 1 month and 10 years are now really close together, and one day of volatile trading could remix the entire yield curve spaghetti. Now, bond prices rise when yields fall. So this is a windfall for bond market traders, but not for potential bond buyers. They have to pay high prices to be stuck with low yields. So why would these bond buyers still buy the 10-year debt? Because they see even lower rates on the horizon. That's what the bond market is telling us. Only a recession that comes with rate cuts and years of QE would accomplish that. So the bond market is clamoring for a recession in the hopes for rate cuts and a new bout of QE. And stocks are in the same boat. Stock market investors had a huge run due to QE and low interest rates for a decade. But this petered out last year, and now the stock market needs another round of miracle medication from the Fed in order to inflate further. So here's the scenario. The economy has hit a rough spot in the first quarter, and first quarter GDP growth will be lousy. That's already a given from the data we have so far. But it will still be growth and not a decline. And there are a number of reasons for this slower growth, including the lower tax refunds, the government shutdown, the weather, and some other factors. But the second quarter will likely pick up some of that delayed growth, as it usually happens, and going forward, the economy might just plod along, not at the hot 3% plus growth rate of last year, but at the typical post-financial crisis growth rate of around 2%. It's said that most run-of-the-mill recessions happen because the Fed is tightening after inflation begins to heat up and wages start rising too quickly and start rising faster than inflation. The economy starts running hot, and the Fed tightens to slow down the hot economy. And after the usual lag of about a year or two, the economy begins to respond and slows down, and then it slows down further and further, even after the Fed has stopped tightening. And then for a few quarters, there's a minor decline as the economy cools. So this is the scenario of a run-of-the-mill recession. But what if this time the Fed stopped tightening too soon, and the economy is slowing just a tad, and is backing off its red-hot pace of 2018, and then no recession happens? Just an economy that is growing more slowly, say at 2%. So no rate cuts are warranted, and a new bout of QE isn't even being discussed. Then there are the effects of the current oil bust that started last September. These effects have worked their way into prices and lowered inflation, but oil prices are already ticking up again, and the oil bust effects will disappear from the inflation data. Wages are already increasing at the fastest rate since the financial crisis, and the Fed has noted. The goods-based sector, which includes retail sales, industrial production, manufacturing, and the like, is clearly backing off its red-hot growth mode last year. Mid-2018, retail sales were growing at rates above 6% compared to the prior year. This is now down to about 2.5%. The transportation sector is seeing a slowdown in shipments too, so the goods-based sector is clearly slowing down. But the vast majority of the economy is based on services. The biggest service segment is finance and insurance, and then healthcare. They dominate the U.S. economy. Revenues in finance and insurance in 2018 surged nearly 8% to $4.8 trillion. This amounts to about 24% of GDP. So there's no slowdown in sight. Healthcare services are the second largest biggie. That doesn't even include the goods-based portion of healthcare, such as pharmaceutical products, medical devices, supplies, etc. This is just services. Revenues rose over 4% in 2018 to nearly $3 trillion. Professional services, that's the third largest services segment. The sector is dominated by computer systems design and related services and by legal services. That sector's revenues grew by over 6% to $2 trillion last year. Even if growth rates in services back off this year from those red-hot growth rates last year, growth will still be substantial. Then there are governments at all levels. The federal government has embarked on a stupendous spending and borrowing spree, and budgets will be further increased. This is a direct stimulus to the economy, and there are no signs anywhere of a slowdown in that department. State and local governments too have increased their spending, and they will cut only when faced with a crisis they're running out of money. So despite the slowdown in the goods-based sector, there is a very good chance that services and government spending will keep the economy in growth mode. And as the effects of the oil bust disappear, this might be coupled with upticks in inflation. And then the Fed will have zero reason to cut rates and plenty of reasons to nudge them up further. And the markets just need to forget about the wet dream of more QE. What will this scenario do to stocks? This entire post-Christmas rally has been predicated on the Fed stopping its rate hikes and ending quantitative tightening, and more importantly, on imagined rate cuts and more QE. When this isn't happening, it becomes a dose of unpleasant reality that will settle in over time. And it is likely to be a huge disappointment for mongers of those dreams of rate cuts and more QE. And that sort of letdown could once again pull the rug out from under the markets. Ladies and gentlemen, I'm Wolf Richter of WOLFSTREET.com. Thank you for listening to the Wolf Street Report.